Welcome to the SafeSimpleSound podcast, where our approach to financial planning creates both and solutions for the contradictions families face. We believe that you shouldn't have to choose between safety and growth, or between enjoying today and securing tomorrow. In today's episode, we are exploring the concept of the exit strategy. This is the fourth and final installment of our Risk Constitution series. If you've been with us for the previous episodes, we've redefined risk, we've looked at the economic system, and we've discussed diversification. Today, we're tackling the ultimate goal of all that planning, freedom. We are basing this discussion on our recent blog post titled The Exit Strategy, Liquidity, Marketability, and True Freedom, which you can find right now at SafeSimpleSound.com. We're discussing this today because of a specific paradox we see often in our practice. It's the paradox of the family that has a high net worth on paper, perhaps millions of dollars in assets, yet they feel financially stressed, restricted, or even fearful. Imagine having a portfolio worth $5 million and still facing the risk of bankruptcy. It sounds impossible, doesn't it? But based on our framework development, we know this isn't just possible. It's a common trap caused by confusing two critical financial concepts: marketability and liquidity. Whether you are a business owner, a real estate investor, or someone approaching retirement with a 401k, this episode will give you the tools to ensure that your wealth is actually accessible when you need it. We're going to walk through the difference between being rich on paper and having true freedom, and we'll introduce the S3 approach to liability-driven investing. This is about ensuring you never have to sell a valuable asset at the wrong time. It's about stability. Let's dive in. Let's begin by establishing the foundation of this problem. In the world of traditional financial advice, there is often a heavy focus on accumulation. The industry is obsessed with the number on the bottom of the balance sheet, your net worth. And while growing your net worth is certainly a part of the SafeSimpleSound philosophy, our practice suggests that focusing only on the total number ignores a vital component of safety: access. Here is the challenge we identified in our recent writing. You can own massive assets, apartment buildings, private equity shares, restricted stock options, and feel wealthy. But if an emergency strikes or a unique opportunity arises, can you use that wealth? This brings us to the critical distinction between marketability and liquidity. In our observation at SafeSimpleSound, these two terms are often used interchangeably, but they mean very different things. Confusing them is where the danger lies. Let's define them simply. Marketability is the ability to sell an asset. If you own a commercial building, or a rental property, or even a rare collection of vintage cars, those assets are marketable. You can put a for sale sign on the building, you can list the cars, there is a market for them. Liquidity, however, is different. Liquidity is the ability to sell an asset quickly at a stable price. Think about the cash in your checking account. That is perfectly liquid. You can use it instantly, and its value doesn't fluctuate based on whether you spend it today or tomorrow. Now, apply this to that commercial building. Is it marketable? Yes, you can sell it. But is it liquid? No. You cannot sell that building today without dropping the price significantly. If you need cash by Friday to cover a tax bill or a medical emergency, and your only asset is that building, you are in trouble. You might have to sell $1 million asset for $600,000 just to get the cash fast. In the financial world, we call this a fire sale. From a SafeSimpleSound perspective, this is the antithesis of safe. It introduces a level of volatility and stress that undermines the peace of mind we are trying to build. We often describe this as the rich on paper trap. Through our practice, we've observed patterns where successful business owners or real estate investors carry a heavy psychological burden. They look at their balance sheet and see success. They see 7 figures, but they look at their bank account and see scarcity. They are terrified of a downturn because they know their wealth is locked up in things they cannot easily spend. This aligns with the principle of stakeholder synthesis. In financial planning, there are 2 main stakeholders: your present self and your future self. Your future self wants growth. Your future self wants that real estate to appreciate over 20 years. But your present self needs cash flow. Your present self needs to pay the mortgage, buy groceries, or handle an unexpected repair. If you optimize entirely for the future self by locking all your money into illiquid, high growth assets, you are starving your present self. You are creating a fragility in your plan. The S3 solution to this is not to avoid real estate or business ownership. We love those asset classes for their sound growth potential. The solution is a both-and approach. We need both growth and access. We need both illiquid assets for the long term and liquid assets for the short term. This involves a strategy we call liability-driven investing. Now, that sounds like a complex technical term, but let's make it simple. Liability-driven investing just means matching your assets to your timeline. It means we look at when you need the money and we choose the investment vehicle based on that time frame. It's about categorizing your money not just by risk, but by time. If you need the money to buy a car next year, that is a liability. We need an investment that matches that timeline, something liquid. If you need money for retirement in 20 years, that is a different liability, and we can match it with a different asset, something with high growth potential, even if it's not liquid today. By separating your wealth into these time-based buckets, or tiers, we create a structure where you never force a fire sale. You never have to sell the apartment building to buy groceries. This provides the stability we look for in a plan. It allows you to ignore the daily fluctuations of the real estate market or the stock market because you know you don't need to sell those assets today. Take a moment to consider your own balance sheet. Do you know which of your assets are truly liquid and which are merely marketable? It's a question that could make the difference between freedom and stress. To illustrate this principle of liability-driven investing and the difference between liquidity and marketability, let me share a hypothetical scenario. Please note that the following story is a hypothetical example created for educational purposes to demonstrate SafeSimpleSound principles. While it reflects patterns we observe in financial planning, it does not depict any specific real-world client. Let's picture a fictional couple. Let's call them Marcus and Elena. Marcus and Elena are in their mid-50s. They have been incredibly disciplined savers and savvy investors throughout their careers. Marcus built a successful logistics business, and Elena invested heavily in residential real estate. On paper, Marcus and Elena are the picture of the American dream. Their combined net worth is approximately $6 million. Here's the breakdown of that hypothetical $6 million. $3 million is tied up in the valuation of Marcus's private logistics company. $2.5 million is in rental properties that Elena manages. $400,000 is in a 401k, invested aggressively in stocks. And they have about $100,000 in their checking and savings accounts. Now, life is good for Marcus and Elena. The business is booming, and the tenants are paying rent. They feel wealthy. But let's introduce a variable, a storm, as we call it in the S3 framework. Imagine the economy enters a sharp recession. Three things happen simultaneously. One, Marcus's business slows down significantly. Cash flow tightens, and he can't take his usual draw from the company. Two of Elena's tenants lose their jobs and stop paying rent. Three, because of the recession, the stock market drops by 20%. Suddenly, their income stream dries up, but their expenses, their mortgage, property taxes, insurance, and their daughter's college tuition remain exactly the same. They need $15,000 a month just to keep the lights on and pay their obligations. They look at their bank account. That $100,000 in cash is their only lifeline. With their burn rate, that cash will last about 6 months. 6 months goes by. The recession hasn't lifted. They are out of cash. Now, Marcus and Elena are in a crisis. They possess $5.9 million in assets, the business, the real estate, the 401k, but they have zero liquidity. They try to sell one of the rental properties. But in a recession, no one is buying. The property that was worth $500,000 last year sits on the market. To sell it now, to get the liquidity they desperately need to pay bills, they receive an offer for $350,000. If they accept that offer, they are locking in a massive loss. They are experiencing a fire sale. Alternatively, they look at the 401k. It's down 20%. If they sell those stocks now to generate cash, they are turning a temporary market decline into a permanent loss of capital. Plus, they might face penalties and taxes. This fictional scenario demonstrates the rich on paper trap perfectly. Marcus and Elena are multimillionaires, Yet they are facing financial ruin because they confused marketability, owning valuable things, with liquidity, having access to value. While this story is fictional, it demonstrates how our framework could have prevented this stress. From a safe, simple, sound perspective, Marcus and Alina failed to synthesize their stakeholders. They optimized everything for the future self-growth in business and real estate and left the present self vulnerable. If we were applying the S3 exit strategy to this hypothetical family before the crisis, here is how we would have structured it using liability-driven investing. We would have organized their wealth into 3 distinct tiers based on time. Tier 1 is the safe tier. This represents money needed in 0 to 2 years. This includes their living expenses, property taxes, and tuition payments for the next 24 months. From an S3 perspective, this money must be liquid. We are talking about cash, money market funds, or high-yield savings. We accept that this money earns very low returns. Maybe it barely keeps up with inflation. That's okay. The job of this money is not to make Marcus and Elena rich. The job is to keep them safe. If their burn rate is $15,000 a month, we might suggest they keep $360,000 2 years of expenses in this safe tier. Tier 2 is the simple tier. This is money needed in 3 to 7 years. This is the bridge. Here, we look for marketability with moderate liquidity. This might include high-quality bonds, dividend-paying stocks, or bond ladders. If the recession lasts longer than 2 years, or if they have a medium-term goal, like a wedding or a renovation, they draw from this tier. It has better growth potential than cash, but it's not as volatile as the business or real estate. Tier 3 is the sound tier. This is money needed in 10+ years. This is where the business equity and the real estate belong. Because Marcus and Elena have tiers 1 and 2 fully funded, they can afford to let tier 3 sit. When the recession hits and the tenants stop paying, Marcus and Elena don't panic. Why? Because they have 2 years of cash in tier 1. They don't need to sell the rental property for $350,000. They can wait. They have the holding power to wait for the market to recover. Through this example, you can see how thinking applies. By securing the short term with liquidity, we actually protect the long-term growth. We prevent the fire sale. Whether you're facing this exact scenario or something similar, the principle holds true. You cannot pay a Tier 1 problem like a tuition bill with a Tier 3 asset like a warehouse without causing damage to your wealth. This aligns with our belief at SafeSimpleSound that true freedom is not about the net worth number. It's about the autonomy to make decisions without duress. It's about being able to say, I don't have to sell today. As we move toward the conclusion of this episode, I want to zoom out. This discussion on liquidity and exit strategy is the final pillar of our 4-part Risk Constitution series. Over the last few episodes, and through the corresponding blog posts on our site, we have built a complete framework for managing your family's wealth. Let's recap how these pieces fit together to form a constitution. In Part 1, we redefined risk. We moved away from the idea that risk is just losing money. We established that risk is actually the likelihood that you won't meet your goals. We discussed that volatility, the ups and downs, is the price of admission for returns, not a sign that something is broken. In Part 2, we discussed accepting the system. We introduced the concept of prime, dealing with inflation and interest rates. We acknowledged that we cannot control the Federal Reserve or the global economy. A plan accepts these external forces as weather conditions, not surprises. We build the ship to handle the storm, rather than trying to predict when the storm will hit. In Part 3, we covered diversification. We talked about eliminating the gamble of single stock concentration. We moved from betting to investing. And finally, today in Part 4, we planned the exit. We've established that accumulating wealth isn't enough. You must have a systematic way to access it. We've learned that liquidity provides the staying power that allows your long-term investments to work. Why do we call this a constitution? Think about what a constitution does for a country. It is a governing document. It is a set of principles that exists above the laws of the day. It prevents the government from acting impulsively. At SafeSimpleSound, our framework development suggests that families need the same thing. You need a governing set of principles that keeps you safe, simple, and sound, no matter what the news headlines say. When the market crashes, or when a business deal falls through, you don't have to rely on guesswork or emotion. You don't have to ask, what should I do? You look at your constitution. You look at your Tier 1 bucket. You see that you are safe. You see that your plan was built for this. This synthesis creates a profound sense of psychological relief. It removes the shoulds and what ifs from your financial life. True wealth isn't about having the highest return in any given year. It's about having the right money available at the right time. When you have an exit strategy, you stop worrying about the market because you know your immediate needs, your present self needs, are already funded. So, how do you implement this? How do you take these concepts of marketability, liquidity, and liability-driven investing and apply them to your life? This episode draws from our recent blog post, The Exit Strategy, which serves as a capstone to our written series. But we wanted to go a step further. Through our S3 approach development, we realized that simply knowing these principles isn't enough. You need to document them. We have created a comprehensive governance document called the Constitution for Family Wealth. This is a downloadable resource available on our website. It integrates every lesson from this series into a single plan. It includes a specific tool, the Liquidity versus Marketability Scorecard, which allows you to list your assets and score them based on how accessible they really are. It also allows you to write your own risk policy statement, the same type of governance tool we use with our high net worth clients. If today's insights resonated with your family's situation, we invite you to go to SafeSimpleSound.com and download that Constitution bundle. It is our way of practicing educational generosity. We believe you deserve to understand the mechanics of your own wealth. Whether you choose to implement these principles on your own, or whether you decide to partner with us, you are now equipped with a crucial capability. You now understand that being rich on paper is not the goal. Freedom of access is the goal. If you find that your current portfolio is heavy on marketability but light on liquidity, or if you feel that tension between your present self and future self, we invite you to explore what financial planning could look like through our SafeSimpleSound practice. You can use the contact link on our site to start a conversation with our team. But either way, remember this: a sound plan is one that survives the short term so it can thrive in the long term. Thank you for listening to the SafeSimpleSound podcast. We look forward to helping you build a future that is safe, simple, and sound.